Let's jump to our mailbag this morning. We have we get a bunch of questions coming in from YouTube and also from emails, etc. So just thought we'd answer some of these questions for you this morning. Why do we have deflation in the country? Well, and it's interesting, why do we have this? So it depends on how you look at it, right? So if you look at the cost of, insurance, the cost of healthcare, the cost of college, etc., that is all definitely inflationary, right? Those are definitely going up. But yet when the government reports inflation, right, we don't seem to really have any inflation, right? We're running less than 2% on annualized growth. Well, a couple of things happen, of course, is that we don't actually measure inflation the way inflation really is measured. Prior to the Clinton administration, before Bill Clinton brought in the Boskin Commission to recalibrate inflation, we used to simply just measure inflation against a basket of goods that were bought each year. So you have think of like a grocery basket, and you buy the same thing every year, and you just measure the price changes of that basket of goods. And so in order to suppress the amount of money we were paying out in Social Security payments, we recalculated how we account for inflation. And so we've done all these mathematical calculations and adjustments to lower the rate of inflation. So it can't, if you are mathematically adjusting something to achieve a specific outcome, it is no longer a valid measure of anything, right? So that's what we have with CPI. It's not a real valid measure of inflation. It simply doesn't account for, what happens to the average consumer, but yet it lowers the rate of inflation. In fact, if you go back talking about inflation in terms of housing costs and college tuition and insurance costs and healthcare costs, et cetera, Social Security, and again, going back to our study here about why, we have this kind of spike in deaths of despair among seniors, is because if a lot of seniors are dependent upon 50% or more of their living income to come from Social Security, and that's not being adequately adjusted for the cost of living, right? So if there's been a couple of years here recently where there's been no adjustment to Social Security. Your Social Security payment was the same from one year to the next, yet property taxes, healthcare costs, property taxes, Texas is the number 6th highest property tax state in the country, right? So those are going up every year, but your Social Security is not, and that's problematic.
Well, it is. If you look at Medicare, Medicare went up quicker or faster than the cost of living adjustment for Social Security. These are things that you continuously see, and if we're going into a stage with higher taxes, that's going to cause a whole nother mess with inflation.
Yeah, and the other side of this is there is deflation in terms of wage growth, because that's the shift from manufacturing. We used to be a manufacturing-based society, which has a very high economic multiplier, to a service-based society, which has no economic multiplier. And that suppresses everything to the lowest possible cost. And as individuals, as consumers, we're always shopping for the lowest possible cost. We want the cheapest TV. We want the cheapest service. We want the cheapest this, the cheapest that. There's a consequence for that, because if everybody's cramming everything down to the lowest common denominator, you've got no profit margins. And so wages can't rise. Wages have to remain suppressed, because wages are the largest cost to any business, regardless of what it is. And if consumers are unwilling to pay more, that's a problem.
So it's the Amazons and the Walmarts of the world that have brought it down.
Right. And so you do have deflation in that area, particularly in wages. You still got a lot of deflationary pressures there because of the demand for cheaper services. Though tariffs are going to be dropped on pork, aren't there other tariffs in place on other types of products? Yes. The process here is that China is wanting the Trump administration to drop the tariffs on pork and soybeans so that they can buy what they were buying back in 2017. Ultimately, this is going to be negotiated down to dropping all tariffs. Trump wants the trade war off the table. China wants a trade war off the table. Everything just kind of wants to get back to even before we get into the election in 2020. So the pressure is going to be, China's going to say, great, I'm going to buy, what we were buying 2 years ago in terms of pork and soybean products, because they desperately need it, if you'll drop the tariffs there. And then once Trump gives in to dropping those tariffs, there's going to be more pressure coming back. Well, why don't you also drop the tariffs on this? Why don't you drop the tariffs on that? And then we'll buy some more, blah, blah, blah. that's how Chinese are going to negotiate. That's why Chinese win negotiations more than we do. And so they're going to wind up coming out, and we'll probably wind up dropping tariffs really kind of across the board to get this done.
Now, what's the economic impact going to be from this net? It's going to be a negative impact because once you get these things back on, just like you said before, you throw some gasoline on a fire, it dissipates, and then you move on down the road. So we're right back to maybe that level playing field or not level, but where we were previously prior to the tariffs.
Right.
But yet we've had all this negative data.
Right.
And a negative economic impact.
Right. Yeah. And the stuff that the tariffs have been in place, just because if I pulled the tariffs off today, the impact of the tariffs are going to last for another 9 months. So it's going to take time to filter through. And look, we're going to have about 1.3, 1.4% economic growth for the third quarter. We have less than 1% currently slated for economic growth in the fourth quarter. That's all primarily due to tariffs.
Now, can we really rely on them doing what they say they're going to do?
No, of course not.
Okay.
That's what I'm saying. They're going to keep bargaining. Yeah, well, okay, great. You took the tariffs off pork and soybeans, but I tell you what, before we buy it, why don't you also take the tariffs off this? And before we increase our purchases, why don't you take the tariffs off this? Yeah. What the Trump administration has done is continually given in to China for the last year. We were supposed to put tariffs on UA, and we gave into that so that our technology companies could sell, product to Huawei, and everybody's like, and Trump's like, I didn't know there was such a big demand. Yeah, and then we were going to put tariffs on discretionary products, and then he backed off of that because of Christmas coming up. So we've continually given in to the Chinese, and this is why they haven't done anything, right? They haven't agreed to anything. They haven't done anything. All they said is, hey, we'll buy some more products that they desperately need. We'll buy those if you'll do these other things. And so that's why, we can have continued to lose this trade war now for the last year and a half.
That's why they don't want an all-out ceasefire, essentially, to this, right? That's they're just chipping away little by little, getting exactly what they want.
Exactly. Is it possible that the Fed move, which is cutting rates today, is only focused on the bond market to prevent any critical bond degradation to junk? Is the Fed trying to swim really against the yield curve? Look, there's a real problem that's brewing within the financial markets, especially in what they called collateralized loan obligations, CLOs, which are kind of exactly like what we had with CDOs during the mortgage crisis. But yes, there's a tremendous amount of risk in the bond market. There's a huge amount of junk bond debt that is on the verge of potentially going bankrupt. We've got a lot of companies that we call, quote unquote, zombie companies that are basically being kept alive in their zombie state by low interest rates. If interest rates go up, they can't refinance the market. So yes, there's definitely some of that to the Fed lowering interest rates. They are definitely concerned about something because, again, if the Fed's two mandates are simply low inflation and full employment, we're there. There's no reason to be cutting rates. Actually, they should be raising rates because of where we are in the cycle. But they're cutting rates because of the issues with Deutsche Bank. There's definitely a funding crisis with banks and excess reserves. That's definitely being addressed through the short-term bill purchases. But yes, there's also definite concerns about the credit risk that is in the junk bond market right now, which is we have the most highly leveraged corporate bond market in the history of the United States right now. What does already priced in mean to the market? Basically, that simply suggests that the markets kind of tend to run ahead of the news. So if we think that something's going to happen, the markets will run up in advance of the actual news. So the markets run up to new highs. Over the last couple of weeks, we've been talking about the fact the Fed's going to cut rates and that you've got now the Fed doing QE. So the markets have run up to new highs. So they've already, basically they bought it's called buy the rumor, sell the news. So they buy the rumor, and then when the news event actually occurs of what they were expecting to happen, typically you get some selling. So that's what it means when somebody says it's all priced in, the markets have already priced in whatever potential outcome that they were expecting to get. At what point should the Fed be held responsible for failing to contain rampant counterparty risk in the markets? They should have been held accountable a long time ago.
Day late, dollar short.
But they never will because, again, they're basically owned by the major banks. Goldman Sachs, J.P. Morgan, Bank of America, they are the members of the Federal Reserve Board. They receive a dividend from the Federal Reserve on that $4 trillion balance sheet. That interest income that comes in on those bonds, they receive a dividend from that. So the Federal Reserve will never be held accountable, and this is why the Federal Reserve always acts in the best interest of the major banks, because the major banks are the members of the Federal Reserve. It's a little bit incestuous. The key thing with the Fed today is to watch what they say. It's not that they're going to cut rates. The odds are like 95% they're going to cut rates today. Yes, they could come out, certainly surprise the markets, not cut rates. Probably not going to happen. They're going to cut rates, but it's going to be what they say. And particularly if they address this funding crisis and their QE, not QE issue, that's what the market's really be looking for today. So pay attention to what the Fed says this afternoon, because it will have an impact on the markets.
So with the Fed and what they're doing, it's an interesting thing you just brought up as far as who owns the Fed, how it operates, and yet we treat it like a government entity.
Yeah.
And so at the end of the day, who's on the hook? Is it going to be the taxpayer, or is it going to be the big banks?
The taxpayer.
Yeah.
We bailed out. And by the way, the Federal Reserve is not a government entity.
Oh, I know.
Right? They have a congressional charter.
Yeah.
But they are not a government entity. They are not, so they are owned by the member banks, and that goes back to the Jekyll Island issue of 1913. So if you ever want to read a good, interesting story, read about Jekyll Island in 1913.